normal sellers. A normal market would have maybe 2 to 5% cash buyers. And when you look today, you have the new normal today, because this is what the government thinks is currently normal. 50% of the sellers today are banks, still. 35% of the market is cash. So you have cash buyers. And then about 20 to 25% of the market are flipped. So you're dealing with investor flippers. So when you start calculating what the market is far from normal, or far from the way we think of it. And why is that? Right? So when you start looking, 92% of the business is sold to the government. Wasn't like that in 2007 and 2008. You were probably at 30%. And so you've got one set of guidelines and rules. You've got two agencies that are in bankruptcy, still in receivership. You've got one that is probably Jenny Mae that basically manages HUD, and then you've got FHA and HUD products coming out of one side and VA loans coming out of another. You do have a lot of veterans coming back, so you've got a big veteran market that you didn't have before. Compliance is a nightmare. You've got a new agency, CFPB, that most of us have not seen. All you guys spend all your time basically in testing for states. You have to be licensed in every state. There is no uniform state test. So loan officers who want to try to do, so if you own property in 2 states and you have your loan officer in California and you want to actually do a loan for somebody in some other state, you can't do that. Banks can. Little loophole in the channel process. The loan process itself appears to the consumer broken, right? It just does. So when you look at it, I think on top of that, you see what we call zero defect underwriting. If you liken it to the car business, when Volvo showed up, America finally got the news that safety is important. And I think that happened in one day in mortgage banking, where suddenly we decided that all loans should pay, everybody needs the correct amount of income, and we're going to underwrite to that.
You're sitting here today with Bill Dallas, CEO of Skyline Home Loans, and our new home, Don. And we're dealing with a little bit of technical difficulty, so bear with the sound a little bit. I'm going to try to fix it here during the break. Don's doing a good job of holding the microphone, trying to keep it in place.
But we're trying to clean everything up back here.
But the one thing I do look at, and I'm starting to see, is I do see some first-time home buyers coming to the market. The move-up buyer is still a little bit afraid. Maybe hasn't saved up enough capital yet to put a bigger down payment down, so that's kind of what's holding up the move-up buyer a little bit. And the other thing is that non-conforming lending has been stuck up until recently, starting to loosen up. So maybe the $700,000, $800,000, $900,000 market starts to be a little more flexible. Then we could start seeing move up, which creates opportunities for the first-time home buyer.
Yeah,
again.
I think it's a good point. I think there's 2 comments that I would make there. One would be that move-up buyers, in order to move up, you've got to be confident that you could either sell your home, and you've got to be confident that your job's fine and that you're going to be able to buy up or buy down. Customers today, about 40% of Americans, about 18% to 20% are still underwater. So underwater meaning their actual mortgage exceeds their home value. And another 20% is right at the Mendoza line. They are right, their nose is just above water. And most people just don't want to move. The other thing about that 40% of those people is that's the group that is modified. They've all modified their home once or twice, so they've got extraordinarily low interest rates. There's still a bit of a struggle. They've got no equity, so I'm just praying that I can stay in my home. In fact, I've always said at Skyline, our job is to take people off the down escalator and put them on the up escalator one at a time. And and it's hard to do because every person presents a separate problem, and then the market that we underwrite to is plain vanilla. It just is. They want no delinquency, no default. So we're coming out of a market that really is almost tightened too much, and the government really doesn't know what to do.
Yeah, I mean, you mentioned a lot of times Don and I, when we talk about 100% financing or high LTV financing, people think that's what causes problems. It really isn't. What causes problems right now is really guidelines. So, for the move-up buyer, the one new guideline that's destroyed the move-up buyer exclusively is the one that you have to have 30% equity in your old home to be able to count the rental income against it. I mean, you remove that one, and you've loosened an entire chunk of people that would love to move up.
Yeah, there's probably, as you know, when we invented the 100%, if you really think back to guidelines and rules, we are, as an industry, still underwriting. Our underwriting guidelines are 75 years old. So the guideline was created for Ozzie or Ward Cleaver. So you had Ozzie and Harriet or Leave It to Beaver, and those guidelines where you have a one occupant, male, generally white, guideline, one job, 2 years stable employment history, fully employed, and that was what you were qualifying. Our rules have not changed. In fact, now that you're selling back to government rules, those rules actually are rules. Before they were guidelines, and so it was just very difficult to expand that. So I agree with you, but there's probably hundreds of rules that you have that need to be changed. The question in the capital market is, as you move from a government-controlled market to a mortgage market that is private, or where you've got private capital that's in it, they had to sort through QM, non-QM, which came out really earlier this year, where they defined the market as a QM loan, quality mortgage, or a non-QM, which is sort of an oxymoron.
Right.
Some of the non-QM loans are better quality than the QM loans. So it really is an interesting dilemma that we've been in. And really, my expertise and Skyline's expertise is trying to create mortgage products that fit today's consumers. So we have to raise capital. We have to find a place that can hold loans, and that we can really experiment with and put those loans into a portfolio and let those loans perform. Once those loans prove that they're fine, then you can securitize them.
See, that's a little different than the way it was done in the past, and a lot of you out there going, wait a minute, didn't we have this creating product thing that created this crash? But you just, and I'm sure it was really hard to follow all that due to the fact that you're not in the know. And what's cool is you're sitting here with a CEO explaining how things are changing in our industry and how we're going to protect from having a mortgage meltdown again. And like Bill, I like that you were explaining that these loans are going to be put into a portfolio, and we're going to watch how they perform. They're not just going to be sold on the secondary market or in the stock market and hope that they perform. We're actually going to watch and see how these loans perform. But you have a lot of history of this, so this is not your first rodeo.
Nope.
So again, if you tune in, this is insider information, sitting with a CEO of Skyline Home Loans who's been in this industry and has changed this industry and helped this industry, and he's got vision to do it again. So stay tuned, because we're going to go a little bit deeper on what opportunities are coming to you to help you get into a new home, get your first home, your next home, or a smaller home if you need to. When we come back to the Don and Gino Real Estate and Finance Show on your hometown station, AM 1220, KHS, don't go away.